This is Real Estate 360 with best-selling author, international speaker, and HGTV house hunter guest expert, Kenn Renner. Kenn, in our last discussion, we talked about real estate, which is what we do in this podcast. And you told a great story about buying property, hanging on to property, and making money, consistently getting wealthy. What are we going to talk about today?
Well, we're going to talk about a little bit about the cycles of the market, and we touched on that with my Rich Dad Poor Dad story last time, but we're also going to be talking about a little bit more about what segment of the market to throw the dart, which is where we do all the research. And I invest in the same areas that my investors are investing in, and that shows a lot of credibility for I could invest anywhere, but where I'm investing, I'm bringing my posse, my folks in to also purchase, and it gives them. It's kind of nice to go down the street and say, okay, I own that one, my friend owns that one, and my Allstate agent owns that one. So that's kind of what it's like when we do this.
So you identify areas.
Yeah. You
identify the area, and you have the data to back it up that says this is a good area to put your money into.
Yeah, absolutely. So the part of the research is studying the cycles of the times, signs of the times, right? And then the next is knowing when to get in, and where to throw the dart, and then also maybe when to get out, and because depending on what market you're trying to leverage, and then going back is to real estate. Always over time is especially in Austin, is very, very consistently going up, but it's not a swinging market like we have in the coast, which causes some major problems. And so, Sandy, I know this is a radio show, but what do you notice about this Austin median price home chart for the last 50 years that I use in my webinars?
I noticed that it goes up, and then it levels off for a little while, and then it goes up, and then it levels off for a while.
Right. So you don't see any big dips.
I don't see anything going down.
Right. So that's the security of owning real estate in Austin, Texas. You may not get these huge 100% appreciations over a 3 or 4 year period like you're seeing in the Bay Area right now, but you're also not going to see the huge drop. So we double in value here every 15 to 20 years for the last 50 years. Wow. And so I tell some of my clients, I just want to get involved in investing. I'm just going to buy one home that's free and clear after 15 years would be a great retirement income. You still get that $1,500 a month or whatever it is, inflation adjusted. And that's a nice little addition to your, but if you own 10, that's $15,000, right? So I tell some of my clients too that for college education, college planning, when you have that first kid, buy an Austin, Central Texas property for say $200,000. When they're 18, it should have. If history repeats itself, it should be worth double. So now it's worth $400,000, right? By then, especially if you put it on a 15-year loan, it'd be what? Free and clear, be paid off. So you have a free and clear $400,000 house. Now you can sell that house, pay the taxes, and pay for your kids' education and probably the rest of your kids' education just from that one house.
My dad did that, bought a house, and that's where we lived in college.
Yeah,
but he bought it when we were 12.
That's a great way to get started. We'll talk in another podcast, those kinds of strategies, and that's one of them. I called in my home buying book, I talk about psyched out for real estate or psyched out for home buying, and it had to be two psychiatrist students from the UT, and that's exactly what their parents did. They bought them a house, put the two kids in, and then rented the other bedrooms out, and they lived for free during the college years. Plus, it was in their name, so they actually ended up with an investment.
Now, this type of investment, oftentimes I think people, when they hear real estate investment, they think, well, I don't make enough money to do that. This is for people that are well into their 6-figure incomes. But that's not the case.
No, it's not. A lot of our investors are pretty much median income, and we do have some real high income buyers that are looking, and they're looking for different reasons. They're looking for diversification, and they're looking for tax shelter, and that's something that real estate provides, and it can be very lucrative. And we'll talk about more of that on some future broadcasts. How it can
look forward to that.
Protect your ordinary income. And that's what happened during, when we were buying properties, because we had so many properties, and we still do, but because we have so many properties, and especially when we're doing acquisition, we had so much depreciation write-off that we didn't pay income taxes. So making good triple six figures, at the end of the day, we were paying no taxes because of the depreciation write-off, right? And therefore, we had what at the end of the year? More money to what? Invest.
Buy more homes.
Right. So I want to go into the cycles really quick, because that's the thing you asked me about is how do I predict the markets? The one thing about real estate is markets are very predictable. We don't know how long or how far or when they're going to change, but we do know they are, and we know that they're going to be more. There's more peaks and valleys than you have. So look at this blue line here. This is going back to 1980, and that blue line is the California market, and we're picking on California right now because they're so high priced.
They deserve to be picked on.
I know.
And I was born there.
I was born there too. So I grew up there. I mean, and I love it. I mean, I still go back. I have family back there, but hey, I got to Texas as soon as I can. Don't blame me for bringing all these Californians out here. You did that on the last podcast. But notice Texas, once again, is much more steady, and the blue line is much more peaks and valleys. So let's give you an example. Is in the 80s, when I moved back to California in the 80s, I moved out of Anchorage, Alaska, which had gone through the real estate, but more of an oil crash because it was an oil-based economy. So in 1985, I sold my house in Anchorage, Alaska, and got out of it really with a profit, even though everybody had shut the doors on that town because the real estate recession and the oil bust of the mid 80s. And so we moved from there. I moved from there to California, and it was absolutely booming. It was like because they had all that aerospace was going on, and they had, as far as you could see, was housing construction going on. I'm like this kid from Alaska goes from a totally depressed area to this huge boom. And of course, from 86 to 1993, I did really well there. And that was the whole thing, was riding that wave up. But then I was really noticing, and that was what happened in the early 90s, is that we had 8% affordability factor in California. And we started shopping around the nation. We came to Austin, Texas, and we found that there was the rents were high and the prices were low. And we're like, what's the problem here? Is that nobody wanted to buy because they had all lost their houses during the great 80s recession.
Right.
So they were afraid. They had judgments. They were embarrassed. And so that also led me on a career path. But when I bought my 3 houses here back in 1992, 91, 92, I was super excited, but I also fell in love with Austin and decided it would be a better place to raise a family than California at the time. And so I got married in 93, and we packed up bags and moved out here. And eventually our whole family moved out, including my, quote, rich dad, who's still alive today here in Austin and doing quite well. So what happened in the 90s was a great move, because we had the .com boom. We had Dell Computers was on fire. I mean, they were tripling and quadrupling their stocks. I mean, it was ridiculous how fast that whole market just blew up. But we knew what happened with .coms. So we started heavily investing in residential real estate because it was the same product I was selling to first-time home buyers, and the cash flow was substantial. And we rode that wave up through the end of the 90s to about 2000 is when Dell started to announce in Austin that they were going to start laying off people. That put a dark economic cloud over the market. Well, in the meantime, California went to the tank and bottomed out in 97. So you notice the difference. We're booming, and because of Dell and that whole tech thing going on, and then California is bottoming out. So that then 97, the market started increasing in California and started really accelerating around 2000 because people were taking their money out of the stock market and putting it into real estate. The mortgage money was easy, and things were started to go up so fast. It was like a Ponzi scheme, right? It was like they bought it, and then it went up $100,000, and then they sold it and bought 2 more at another 100. So it started going up faster and furious. So about 04, I noticed that we were just coming out of our recession, and California was like booming. And that's where I noticed the difference in the markets, and that's when I started going out and bringing back investors, saying, you should get your equity out of the area before it evaporates.
Were you believing that the economy in California, because the economy in Texas was coming out of it, you thought California was going to go into it?
Well, it's just the dynamics of...
Because it had happened before.
It's the 7 to 10 year cycle.
Right.
And they don't always fall in the 7 to 10 years because we're in a 10-year cycle here, but I think it's going to extend because of the depth of the last recession. But once again, remember, you saw the charts on the awesome median home prices. The prices didn't drop here in the median home or below. The volume dropped, as we see on the chart, but so we're able to preserve our investments even during a recession, preserve the equity, and that's one of the things people are looking for. Am I going to lose my shirt? Or we didn't. We just one of the things that we saw that 05, 06 was where the mortgage money was getting so easy. It was a false increase of availability of money, which drove up the prices even faster and quicker. Like I said, 17% appreciation in 1 quarter. And they were saying, why would I invest in Texas if it's crazy market out here? Whenever you hear the market's crazy, watch out. There's a big clue is that this market is just crazy. Watch out.
I'm hearing that. I'm not in the game like you, but
Yeah.
I do hear that about Austin, Texas.
Yes.
It's crazy.
Yes.
Is what I hear.
Yeah, so we have to know where to throw the dart because now after the Great Recession, we've had 10-year expansion. Austin's benefited from that, but not at the 100% appreciation that we've seen in California. It's been on this normal, consistent 5 to 7% per year, which is a good growth pattern. So, over the time, that's going to double your money, double the value of property every 15 to 20 years. So you asked that question. So number one was how much more steam do we have left in the Austin market? And I would say, if you asked me last year, I would have said, well, we're just studying the cycles. Probably this year is probably going to start leveling out again. Too much volume. We have 200 people a day moving here, 200 people a day, many from the coast. And so there's just too many people coming to, so where are they going to live? And I mean, they're driving up the prices, yes, but they also, if they can't afford it, they rent. And that's where we become landlords. So, and we increase our rents as that continues to go on. So after seeing several presentations, having lunch with one of the top economists and picking his brain about this market, he said, yeah, we're looking at probably another 2 to 3 years of strong growth in our Austin market. The coast market is so overheated so far, we don't know when it's going to change. But like I said before, if it makes the news, then you got to watch out. And then already I'm following the Bay Area news and the Southern California news. My sister's a broker in Southern California. So she's like saying, yeah, volumes are going up. The amount of homes on the market are starting to increase. In fact, you can Google it yourself. But when it starts to make the news, the regular news, it's probably almost too late.
That's what I was about to ask you. Because in my brain, when it makes Lester Holt's news at 5:30 at night on NBC News, and you hear about a housing market crisis, to me, it's already there. It's too late. The insiders like you know.
It's about 6 months behind is what I've seen in the past. And so that's what's nice about it is being able to realize that once they start talking about this, now just take the mentality. This happened in 05, 06. The people in California own these properties. They've been going up so far and so fast, and they're continuing to do that. And all of a sudden you hear the buyers are like, "Oh, I'm not paying that anymore. I'm just not." And that's happening right now. This is crazy. I can't afford this. Right? When you hear that, it's crazy. I can't afford it. So I'm going to stay on the sidelines. And then what happens?
That's a problem.
Then somebody wants to sell, and they're not having any problem right now because there's still a short supply, but they want to sell. They're like, the buyers are going, well, it's going to, according to San Jose Mercury, it's going to go down 10%. It's going to drop 10% this year. Why would I buy now? I'll just wait till next year. It causes a tumbling effect of the market because the news becomes people's reality. It's a shame. You're in this industry. You're in the media industry. You know how, we
can influence things.
Absolutely.
Good or bad.
Yeah. I mean, it is true. And so I don't see those signs in the paper here in Austin, but that goes back to where we throw the dart. We're looking for markets that offer solid cash flow, little hassle, good appreciation, and high liquidity. So I know you can't really tell this chart, but people love this chart because we don't want to go on too low of a sales price in the areas that have problems, let's say, because it becomes high hassle. It offers higher cash flow, but because run down old area in areas that people don't want to go at night, and that's where a lot of investors like to invest. But the problem is that you have good cash flow. It appears that way until you have to realize that, like I just sold 2 duplexes in North Austin. They're 40 years old. Well, these 40-year-old houses need everything. I mean, the whole 40-year duplexes need everything. And you don't figure in that the capital expenditures of replacing all the air conditioning units and all that kind of stuff. So that's the whole idea is that you get high cash flow on those very low prices, but then you get low liquidity. People don't want to buy them in tough times. Appreciation's okay, but not all that great. And then the hassle factor. So the higher you go in the price points, the cash flow goes down, but your hassle factor goes way down. And then your chance for appreciation and your liquidity, which is like, how am I going to get out of this, is much higher. And that's the middle of the market. That's the average properties. That's medium price. So what we focus on is not the low end, but not also and below the median price. And median price right now in Austin is around $300,000. So most of our investors are investing anywhere from $150,000 to 220, 230. Some of them are going up to 250, and a lot of it has to do because we have the new Apple facility coming in, and just the domain and Google and Facebook, and Facebook just took a 13-story tower in the domain. Everybody wants to be near that area, and so we have some markets in the Austin metro that we concentrate on newer construction that keeps your hassle factor down because it's under warranty, it's new, and I like my new properties. I still buy new, so hassle factor is down. Rentability is great because everybody likes a new car, everybody likes a new home that they get to rent. And with 200 people a day, we have very low vacancy periods and vacancy factors. So, but then we also have submarkets that are outside of Austin, still commutable or just other economies that are booming as well, but offer higher incomes and lower prices. In one of our submarkets, where the values are 60% for a brand new construction of where in there it's within 40 minutes of Austin city limits, 60% of the value of Austin homes, but 90% of the rent. So the rents are high, the prices are low, and they're appreciating very solidly right now. So time is try to get in and get as many as you can now before the prices go up. Austin's prices went up too fast for our average investor in most of our areas because the rents haven't kept up. But we do have very good areas that we target. And so we're more onto the newer, like less than 10 years old because of the construction, great locations, like we said, geographics, demographics, education, employment, and infrastructure, freeway systems, and parks, and quality of life. Everything that you'd want is what we want for our tenants. So that's what we look at, and that's where we throw the dart.
Do you find that everybody's different? And some people, do you kind of identify what they want to do? There's some people, they don't mind the house that needs new air conditioning. That's all part of it to them. And other people, they're like, no, I don't want anything to do with that. Do you find and cater to those people?
Yeah, absolutely. I mean, I just bought two houses that were built in the 50s, but I paid $72,000 for one and $85,000 for another. That was my first experiments on that low end market, but it was in a different submarket. So it has too many good factors that we like. Employments are with hospitals are within walking distance, and strip malls are right there. So that's our first. My wife's first jump into a 50s house in a long time.
Oh, but you could market it as a mid-century.
Mid-century
Yeah,
on stilts.
That's what people that buy homes.
But you
from
think
the 50s.
about those mid-century homes that sold in downtown Terrytown.
Oh yeah.
I mean, it's like the San Jose prices. Those areas have just gone really, really. So, but our typical investor is not one that's gonna. They don't mind doing if it's carpet and paint, we got to fix an AC.
Sure.
That's not a big deal. But if it gets to be more in the renovation, that's not my area of expertise. Now, I do it for myself, but I don't even change my own light bulbs. I mean, at my house, I'm not handy, and and so I would have to hire somebody to do all that, and it's not my area of expertise.
Right.
Mine is more get a good property, a good area, buy it, let the tenants pay it off. Our interest rates are so low. I mean, under 4.5%. APR. I'm sorry, the disclosures on the APR, but under 4.5%. I mean, the payments are substantially lower than they were just 6 months ago because of the drop in interest rates. It's just a great time to buy real estate.
Yeah, it is. I keep hearing it. It's time to do it.
Yeah, but you also know where to stay. I've got to know where to stay away from. And one of the areas that we do stay away from is where too many investors are buying at too fast a clip. That I'm not the only one selling investment properties. And this happened during the last boom cycle, is people would find out where I'm investing, and then they would tell their two friends, and they wouldn't even talk to me, and they go out and buy in the same areas, and now we got all this competition. So why I'm being a little more vague on the exact areas is I want to build a relationship with our clients first to see if we're a good fit, and rather than them blabbing to everybody where our gold mine is.
Right.
So we just don't want to tell them where the gold mine is until we have a relationship.
But they can call or email you and find out.
They can. It's Kenn, Kenn, at buyaustin.com, BUY Austin.com. That's Kenn at buyaustin.com. Don't forget the two N's in Ken. Thanks, Dad. And then my phone number, and you're welcome to call or text me. I mean, we talked about this last time, Sandy. I just had a conversation in the car here. He goes, I know you're so busy, and I know you're so, because you do these podcasts and you write books and you're selling. I'm like, and that's what I do for a living. Don't be afraid to call me, or no, you're not bothering me. If you're one more step closer to buying a home, I want you to call me at 512-423-5626, or even better, text me. Because I always check my texts, and I want to help. And I can't help if people think I'm too busy to help them.
Right.
So,
Will you flat tell someone, no, don't buy a house there?
absolutely.
You will. Good.
Oh,
That's
yeah.
what you got to be.
Well, I mean, I'm going to say, I never tell somebody not to do something. I'm going to tell them why.
Right.
I mean, there's certain builders. What I do, I point especially if they're walking through a house with me, I go, let me show you some things about this house. Why we don't buy this product over the long term. They're going to. I mean, I remember this one. We won't mention builders' names, so I don't want to get in trouble. But I remember one time about 10 years ago, they were one subdivision. The construction was so shoddy that there were people down the Button Pass with picket signs on I-35 freeway. And the news came down and everything like that. We don't buy from those builders, and
Right.
they're not. They're farther and few between these days. But we have great relationships with not only our builders but other realtors that know what we do. A lot of times they'll come and approach us with a property because they know I have investors.
Right.
And plus, we're also rolling out some very cool programs we call them move assistance programs, and we're going to kind of take a small scale open door or Zillow concept where we're having our investors buy good houses in good areas that are already rented out or the owner's building a house and they want to sell their house. They can stay there as a tenant. That's and it's a great plan. It works really good. It's a win-win for everybody around. No vacancy, and you get the owner now becoming the tenant. It really is a great opportunity. And so it's not only knowing where to throw your dart, but also the team that you have that we have that you want to be connected with, the leader and the team, right? Do you bet on the horse or do you bet on the jockey, right? So, and you can see our picture of our team there on Sandy, and we've got a good solid team that handles everything from beginning of acquisition, research and acquisition to management and disposition. So if you want to get started and have a conversation with me, I'd be more than happy. I've got great videos. You can go, check
YouTube
out
channel.
my YouTube channel. It's Kenn, Kenn Renner, RENNER.TV. It's the #1 YouTube channel in the world, as far as I know, from an individual realtor. It has over 11 million views. But it has some great resources, including playlists on my live presentations and things like that you can look at. But I also send out I do a lot of video because it's very engaging and also it's very educational, and you can see what our methodology is. And then we invite people either to take a look, and about 30% of our clients will fly out here, and which I would if I were you. We highly encourage that. 30% of our clients don't fly out here. About 70% actually come out, take them on a tour, get them all excited, and usually they'll either buy 2 or 3 at a time once like I did the first time I came here in 1993. Is like, I could put this on a gold card, is what some of my clients are saying. So.
Well, make sure that, first, thank you very much for listening, but make sure go to iTunes, subscribe to this podcast, or wherever else you get your podcasts.
Thank you, Sandy. I appreciate it. We'll talk to you next week.